What's up everybody, welcome back to AZ Trading. Hope you all had a great weekend, ready for a brand new week of trading. And over the past few days, you guys have been absolutely mental with the support for our channel. We managed to reach 1,000 subscribers, which is just nuts. Our community is growing, and just seeing you guys interact and helping each other become better traders just makes me incredibly happy. So thank you all once again. And just as a way to show how grateful I am, I made a little poll on YouTube and Discord, and you guys voted for a live trading session as well as a one-on-one lesson giveaway. But then I thought, why pick one or the other? Why not just do both? So that's what we'll do. Just give me a little while to figure out how to stream on YouTube, since I've never done this before. But if you'd like to enter the one-on-one lesson giveaway, first you need to join our community Discord, and once you've done that, head over to the testimonials channel over here and leave any comment on your experience with me, whether it's positive or negative. As long as you're honest, that's all that matters to me. I'll be randomizing a winner at the end of the week. Alright, this wouldn't be a true AZ trading video without some technical analysis, so let's get right into it. Yesterday, the 10th of October, on the NASDAQ, we managed to capture this 100-point bearish move. So stick around and I'll give my entire thoughts and analysis that led to capturing this trade and the strategy that we use so you can capture trades like this one in the future. You guys already know we don't use a replay button around here to teach. As you can see, my executions on the chart show that this trade was taken live and not in hindsight. I can show you guys the labels as well. So if you guys watched any of my previous videos, you'd know that the pattern we trade with is the RMR pattern. So if first we look for a raid, so above some relative equal highs, we can call this the raid as price reaches through it. The next thing we look for is a market structure shift. So price is currently bullish. It's bullish until it starts to break lows. So right over here, price broke a swing low. So this is what we'd call the market structure shift. And then after the market structure shift, we wait for a return. So we have a bearish order block in here, and we also have a 5-minute gap. I'm just on a 5-minute chart now, and we can see that there's a gap right in there. And so as soon as price retraces into that return area, that's where we'll be able to look for shorts. And if we placed our short as soon as that gap or order block was reached, we'd place our stop loss at the raid's high up here, and then we'd look for objectives below. And for my objectives, you can see that I took 3 partials, with my first partial at this swing low, my second one at this next swing low down here. My second last partial, if you look to the left once more, we have a gap over here. As soon as this gap was filled, I took off my third partial, and my final position, if you look to the left once more, we have these relative equal lows, and as soon as that equal low area was reached, that's where I took off my final position. However, the point I'm trying to make is just because you know how to see and how to use the RMR pattern, this is only half the battle, since this is the identification skill. So when you get good at identifying the RMR pattern, you'll be able to see it everywhere, such as we can see a raid under these lows, a shift above this high, a gap, and as soon as it returned into that gap, we could be a long. However, another identification RMR you can see is above this swing high is the raid, below the previous swing low is the shift, and as price retraces into this gap and you decide to place a short, you can see that this trade would not be such a great idea. So once you've learnt the skill of how to identify the RMR pattern, the next important thing to learn is the understanding side. What this means is you'll be able to identify many instances of the RMR. However, when you practice the understanding side of things, you'll be able to filter out the RMRs that are less likely and to focus on the ones that are the highest probability. Both of these topics are very important, but the point is once you get good at how to identify the pattern, the next thing to learn is when or when not to use it. So let's start with the daily bias. So before I place my trade, first I have a daily bias. So this will help me determine whether I want to be a long or short for the day. And to determine my daily bias, I'll be looking at liquidity above the market and liquidity below the market. And you can see that as soon as the week began, we have these 3 lows that were painted. And we all know that under relative equal lows is resting sell side liquidity, which would be a likely objective. And if we have a look at the liquidity above the market, we have some swings, but not very clean equal highs. So in my eyes, these equal lows had more liquidity than these highs up here. But if we think about what retail logic would be thinking, so if they place their longs all throughout the day, where do you think the most likely area of their stop loss would be? Most likely it'll be at these swing lows. Not only that, a lot of retail traders will be waiting for this area to trade into for them to place multiple long entries. And so all of these orders gathered at this area, whether it's stop losses or entry positions, this is just liquidity for the market. So instead of seeing price in the terms of retail with support and resistance, try to see things in terms of where liquidity is resting, because that's likely to where price is reaching for. So price trades throughout the day and we reach around 4:30 in the morning during London session. I was watching this bearish price leg and I was expecting this bearish price leg to take out the retail traders, to take out this area of liquidity. But what happened? We can see that price did not reach that area and ended up rejecting once more. So what do you think I was thinking at this moment in time? I was thinking that price did not grab the liquidity, and not only that, if we look to the left, price made some relative equal lows, which means that even more liquidity is resting there. So retail traders placing their longs, seeing this area as a strong level of support. They've seen this additional bounce, and now they're starting to trust this area even more so. Now retail traders are buying and buying and buying, placing their stops at the swing low or having their limit orders set to buy at this area of support. And this is all just a pool of liquidity, which makes this an even more likely objective for us. Alright, so just based on what I've said so far, my daily bias, you can tell that I'm leaned towards bearishness for the day. What this means is I'll be filtering out any bullish RMR patterns and I'll be only focusing on bearish RMR patterns. So that first example that I showed you guys, this raid, shift, and return into this gap for a bullish trade, yes, you have identified the RMR pattern very well, and it would have been a winning trade. And I'm not saying that you shouldn't trade against your bias, but for my own trading framework, I'd filter out this bullish trade opportunity and look for a bearish RMR to form, just like this one over here. This is something I love about the market, because everyone will have different directions and different ideas. This guy placing a long here, someone placing a short here, both traders with such individual ideas, and they'd both end the day in a profit, which is one of the reasons why trading will never be boring for me. Let's move on from daily bias and let's talk about sentiment. So if we scroll a bit to the left to the week's open, we can see that sentiment throughout price to the end of London open was very messy. It's just consolidating, going up and down within a range. However, if we look from the middle of London open to New York open, we can see that price is very obviously bullish. So you can imagine people waking at the New York open. As soon as they see price, they can see this bullish sentiment, so they're more likely to buy and buy and buy, since they're trend following in nature. And so if we can determine that the sentiment was very obviously bullish, what this means is that more liquidity is resting below swing lows and liquidity above is constantly being taken out. All this means is that the liquidity below the market is likely to be taken out, since all the traders going long, placing their stop loss at the previous swing low to trail their stop. The market sees this as just resting liquidity, and we can anticipate the sentiment to be broken, meaning stopping out these traders. And in order to break the sentiment, we'll need to see a bearish move in price. So if we're anticipating a bearish move based on sentiment, and our daily bias is also bearish towards these equal lows, the last thing we can look at is the relative strength. What this means is if you're trading the indices like the NASDAQ, S&P, and the Dow, if you've decided to take a short position, using relative strength will help you decide which one of those three to short. So I've just zoomed into a 1 minute chart and my entry was around 9:31. So this was when the return area was reached. So prior to your entry, if you're looking to short, you'll need to find which one of the three is the weakest. So just before our entry, if we pick a few swings, so let's choose this swing low here and this swing high over here, we can see that NASDAQ retraced very minimally. On the S&P, this was the swing low, this is the swing high. And you can see that S&P retraced much more deeply. If I use a fib, you can see that S&P retraced above 62%, whereas on the NASDAQ, it retraced less than 50%. And finally, we're on the Dow, and you can see that the swing highs that we were comparing was this one up here and this swing low down here. And you can see that Dow has retraced much more deeply than the two. And if we just measure with a fib, you can see that not only did Dow retrace very deeply, but it also broke this swing high. Whereas on the NASDAQ and the S&P, this swing high at 917 was not broken. NASDAQ 917, this high was not broken, and S&P 917, this high was also not broken. Alright, now that we've done the relative strength analysis, we've determined that NASDAQ is currently the weakest, S&P was slightly stronger than NAS, and Dow was the strongest of the three by far. So if we're looking to place a short position, we want to take advantage of the relative strength so we can short the weakest indice of the three. And I'll just show you guys what would have happened if we didn't choose to short the NASDAQ. So on NASDAQ, we short at 931, and you can see we wouldn't have been stopped. On S&P at 931, if we shorted and we put our stop at the raid's high, you can see we also wouldn't have been stopped. However, on the Dow, if we placed our short at 931 with our stop loss at the previous swing high, you can see that our trade would have been stopped immediately. Now that we've covered the understanding side of things, so our daily bias is to be short to the equal lows. The current sentiment was bullish, so we were looking for a bearish reaction to stop out retail traders that are going long. And if we decide to short, we've used our relative strength analysis to determine to short the NASDAQ. Now with all that in mind, then we can start to find the RMR pattern, which has occurred right over here as I labeled at the start of the video. And this was the trade overall. I just want to mention something that I could have improved on for this trade. So although my final objective was these equal lows, so I let 10% to run at these lows, something I could have done to improve this trade was, instead of taking off 10% there, I could have taken off 5%, reducing my stop loss to break even and letting my position run to the next objective. And I've just zoomed out to an hourly chart, a 2-hour chart, and you can see that the next objective would have been this swing low over here. You can see that holding on to that partial to the next objective would have been an amazing idea. However, this just wasn't in my mind at the time. So learning how to not attach yourself to your position and letting a portion of your position run, no matter how small it is, getting into the habit of letting partials run and not taking out your profits early is a very important skill to learn in trading, since trading is not all about how to control your losses properly, but also about how to control your winners. But that'll be it for this video, guys. Once again, thank you so much for all of your support and helping us reach 1,000 subscribers. If you enjoyed this video or learned something new, don't forget to leave a like and subscribe. It makes me very happy. And if you've got any questions, feel free to leave them down below. I'll get back to every single one of you. But until next time, take care everyone. Peace.